Every landlord knows about mortgage interest and property taxes, but that's just the surface. What I see too often is landlords leaving legitimate money on the table because they're missing deductions the IRS actually allows. Hi, my name is Angeline Smith, and I share content on strategic business operations, financial compliance, and profit optimization. In this video, I'll walk you through 5 commonly missed tax deductions that can make a real difference on your Schedule E and on your bottom line. Let's start with the first deduction that's often overlooked, one that's hiding right in your own home. If you perform tasks like bookkeeping, maintenance coordination, or tenant communication from home, a portion of your household expenses qualify as business use. You can deduct a share of your utilities, internet, insurance, and even rent or mortgage interest based on the square footage used. The key is that the space must be used regularly and exclusively for your rental business operations. Deduction number 2 is one that nearly every landlord qualifies for, but rarely tracks properly. Every trip you make to your rental property, whether it's to meet a contractor, check repairs, or pick up supplies, adds up. Those miles are deductible at the IRS standard rate as long as you document them. Keep a simple mileage log or use an app to capture the date, purpose, and distance. If you travel overnight for property management, lodging and meals can also qualify. Number 3 often surprises landlords because many don't see education as a deductible expense. If the education or professional service helps you operate, manage, or improve your rental business, it's deductible. This includes courses on bookkeeping, tax strategy or landlord law, memberships in professional associations, and fees paid for accounting or legal support directly related to your properties. These are all legitimate business expenses that reduce taxable rental income. Now, deduction number 4 is one that many self-managed landlords forget, and it's right in their hands. If you're using your phone or internet to communicate with tenants, contractors, or your accountant, that's business use. You can deduct the percentage of your bill that relates to rental management activity. Just keep reasonable records, phone logs, emails, or screenshots to support your calculations. And finally, deduction number 5, which ties directly into long-term financial compliance: depreciation on appliances and improvements. Many landlords expense big purchases in the year they buy them, but that's not always correct. Appliances, flooring, roofs, and HVAC systems should be capitalized and depreciated over several years. That approach spreads the deduction, keeps your records audit ready, and maximizes long-term tax savings. So here's the bottom line. Schedule E isn't just about reporting income. It's also about protecting it. If you miss legitimate deductions, you're overpaying the IRS and underfunding your own business. Now, let's take a quick look at what to remember. Every legitimate deduction requires documentation, not guesswork. When you track expenses properly and claim what you're entitled to, you strengthen your compliance position and your profitability. Because what you keep after taxes is what truly grows your rental business. If you found these insights helpful, I think you'll benefit from my free Schedule E compliance guide. In it, I outline the 5 QuickBooks customizations that every landlord needs to stay audit ready and tax compliant. You can get my free guide by going to asmith-accounting.com www.landlords.com/free-compliance-guide. The link is on your screen and in the description of this video. Protect your rental income. Protect your peace of mind. Get the guide today.